0.6% retail sales crash. Stop trusting consumer growth. A 0.6% retail sales decline demands that you secure your consumer growth and strengthen demand resilience. You should not dismiss July's 0.6% retail sales decline. It was the first drop in 9 months, largest in 14 months, and worse than 0.1% expectations. Core retail sales fell 0.4%, pressuring GDP expectations, while Goldman Sachs lowered third-quarter growth to 2.2%. Q1 consumption was modest despite strong productivity and capital investment. June's unusual surge reflected tax refunds, Amazon's Prime Day shift, and competing promotions, potentially pulling $5 to $8 billion forward and increasing promotional intensity 150 to 300 basis points. Still, blaming calendar distortions entirely is dangerous. July sales remained 5% above last year, while consumer prices rose 0.1%, pointing toward weaker purchasing volume underneath. Non-store retail sales plunged 2.2%, motor vehicle sales declined 1.8%, electronics and appliances dropped 0.5%, and service station receipts fell 0.9% as gasoline prices moderated materially. Lower gasoline prices can release household cash, but affordability pressures remain across food, housing, transportation, and financing, while weakening sentiment makes discretionary demand increasingly fragile. The Federal Reserve held rates at 3.5 to 3.75% on July 29. 3 FOMC members favored a 25 basis point hike, making September 15 to 16 crucial for businesses watching demand. You need to distinguish normalization from genuine demand deterioration because confusing June's promotional pull forward with sustainable growth can inflate revenue expectations and create costly inventory problems. Impact Solutions estimates real consumption softness around 0.8 to 1.1%, warning promotional distortions could overstate annualized run rate revenue 3 to 7%, especially after 4 to 6% promotional pull forward effects. Nominal sales growth of 3 to 5% can conceal flat or declining unit volumes of 1% to 3%, meaning pricing rather than genuine volume expansion may carry performance. Promotional timing can distort monthly comparisons by 2 to 4 percentage points, while quarterly promotional concentration can reach 20 to 35%, creating volatility, margin pressure, and misleading management forecasts. Discounting is becoming less productive. A 1% increase may generate only 0.3 to 0.6% volume, while discretionary gross margins face roughly 100 to 250 basis point pressure year over year. Because consumption represents roughly 68% of U.S. GDP, even a 0.5 to 1% consumption growth shift can affect overall economic growth by 30 to 70 basis points materially. Businesses with high fixed costs, weak pricing architecture, and promotional dependence could experience 15 to 25% EBITDA swings, while discretionary elasticity may have tightened 10 to 20% from pre-2022 norms. Stress testing matters. A 3% revenue decline can compress EBITDA 5% to 8%, a 6% decline 10 to 15%, while 10% declines can trigger liquidity stress above 60% fixed costs. You should build pricing around elasticity. Categories near minus 0.2 to minus 0.4 differ sharply from those exceeding minus 1.2, while disciplined segmentation can preserve 150 to 300 basis points. Inventory deserves equal scrutiny because stocks 8 to 12% above optimal turnover can reduce annualized returns 200 to 400 basis points, while calibration can cut working capital 10 to 18%. Impact Solutions recommends 3 to 6 months of operating expense liquidity, noting sub-2-month buffers heighten risk, unemployment, credit utilization above 30%, and 1% unemployment increases deserve monitoring. A stronger dashboard should track 8 indicators, trigger action when 3 deteriorate more than 5%, diversify channels to reduce concentration 10 to 15 points, and improve allocation accuracy 15 to 25%. You should replace annual budgets with quarterly scenarios. Test 5% revenue declines, 8 to 12% cash flow variability, 200 basis point margin compression, 20% plus net income impact, and 2 quarters before expansion. Can your business survive a 0.6% consumer demand shock? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.